Hi, welcome everybody. Thank you, Dhanpal, so much. Thank you so much for joining us today and giving the insights of what's happening. And people in this post-COVID has been listening a lot of webinars now for last 20 days or so. But thank you so much for joining us today. This has been organized in association with collaboration with JITO Professional Forum. Ravi is there, Ajay Bora is there. Will be leading from JITO Professional Forum. From my team, we have Rajat, Siddharth, we have Anup there, and also Mahesh. Pooja is there, and Swanbadi is also there, which is part of the JITO Angel Network. Dhanpal, you're already aware, for all the listeners and the participants, Dhanpal Jhaveri is also a JITO and a JIIF member. And he's been, come on board last couple of months back. And we are thankful for him to accepting our invitation also. JITO Angel Network has been there for last 3 years now. JITO Incubation Innovation Foundation with a incubation center, which is there for, we are almost having 110 seats. We have 36 companies we've been incubating. And on the funding part, we have almost invested around 42 crores in 22 companies. And we have a collaboration with almost all big IITs and the education institution in India, IIT Chennai, IIT Delhi, IIT Powai, SBT, Techstars, we've been doing a lot of program. IIM Ahmedabad, we've been doing a lot of collaborations with them, a lot of co-investing done with them also. In terms of JITO's activities, we already know what JITO has been doing for last 20 days post this COVID. JITO is a strong organization where synergy flows all across. We are doing all philanthropy work, whatever we can do best in terms of the grocery kits and also the food packets, whatever best we have been able to do. I would welcome all. I would ask Ravi, who's the director in charge of JITO Professional Forum, to just say a few words on this, and then I think Rajat and Ajay can take it forward. Thank you so much. Ravi ji, आप start कर सकते हैं.
Thank you, Manoj ji. Now talking about JITO Professional Forum, it connects professionals from various sectors and creates a collaborative advantage for their professional benefit, growth, and benefit of the society. I believe coming together is a beginning, staying together is progress, and working together is success. JPF and JIIF has come up with this webinar itself is an example of working together. Finally, I want to say that only way we can live is if we grow. The only way we can grow is if we change. The only way we can change is if we learn. The only way we can learn is if we build a good network. And I want to tell you all that we already have a very, very good network platform in the form of JITO Professional Forum. Without taking much of your precious time, I would like to invite young and dynamic personality and JIIF Vice Chairman, Mr. Rajat Mehta, to take the webinar from here.
Thank you, Ravi ji. Thank you, Manoj ji. So today's webinar and the session on long-term investments in India and private equity space will be moderated by myself and Mr. Ajay Bora ji. I am from financial services background. Ajay Bora ji has several accolades. It will be difficult to mention all of it, but he is a successful serial entrepreneur. After having sold a very successful business in America, he has also created one of the foremost educational credit platforms called Credila, which is now called HDFC Credila. He is highly revered in the financial services and the credit space. He is advising government on several such initiatives in terms of student credit and student loans. He's a part of UGC. He's a part of Senate in his university where he's graduated from VJTI, which is a very, very famous engineering college. So today, both of us will try and moderate this session to the best of our capabilities. Key takeaways for today's session is, COVID has happened. While everybody was talking about long-term investments, India is a great investing destination, for Indian investors as well as investors from abroad. A lot has changed today, and we must all pay attention to, to what we could expect in the near future and in long term. There are a lot of questions in everyone's minds. We've already received over 100 questions in the last 5 days since we started registration. So we know that, people have questions, people have doubts on several topics. People want to understand how do we operate going forward. If they are a businessman, people want to understand how do we run our businesses. People will need a lot of money going forward to get things back in action. So will private equity money, long-term money continuously flow into India, or will it not, or will it pause momentarily? Because a lot of plans, a lot of future targets have been planned basis a lot of fund flow. So businessmen are eagerly trying to understand whether banking investments are on its way, or can we look at a very adverse situation. At the same time, for investors and young startups, people are trying to understand what is the opportunity going forward, and what is it that we should look at, because this is a very changed world. Nobody had actually planned for this, nobody accounted for this. In 2008 we had a lot of economists and heroes saying that we predicted this, we saw something like this happening. But this kind of a economic shutdown all across the world at the same time, with a healthcare scare, is one of its kind. It's never happened before. So today we should try and make the most of it with Mr. Dhanpal Jhaveri, who is an esteemed private equity expert, and he's always been a supporter of JITO and JIIF. He's also a member of our angel network. I should just inform you that our angel networks is one of the most active angel networks across India. Within 3 years of maybe less than that, we have really accomplished a lot. And we help and nurture a lot of startups in different businesses to grow. And we've been able to demonstrate that in the last 2 years. Without wasting more time, I will hand over to Mr. Ajay Bohra ji to introduce Dhanpal Jhaveri ji. One request you to all put your questions in the chat box. We will pick up questions from there. All questions are relevant. So with no disrespect, all questions cannot be answered today. We will take up some questions which we think that would serve purpose for most of the questions that are coming in. Some questions that may not be answered today, we will try and request Dhanpal ji, to answer them whenever he can over a period of time. We will collate them, we will send it to him, and we will get an expert opinion on some of your questions. With this, I would like to thank everyone for coming and joining us. Then over to Ajay ji.
Thank you, Rajaji. Dhanpal Jhaveri needs no introduction. He's the guest as well as he is the host of this program, being a part of JITO and JIIF. Dhanpal ji is the Vice Chairman of Everstone India and CEO of EverSource Capital. Dhanpal Jhaveri is as a Vice Chairman, that Everstone India is a premier investment group focused on India and Southeast Asia. Assets in excess of over $5 billion. They operate in private equity, real estate, green infrastructure, and venture capital. He is also the CEO of EverSource Capital, which is a joint venture between Lightsource BP and Everstone Capital to make green and sustainable investments in India. Dhanpal's previous experience include corporate strategy with Vedanta Resources and head of investments banking at ICICI Securities, and also partner for corporate finance at KPMG. He has earned his BCom from University and MBA from Babson College. With that, over to you, Dhanpal ji, for your opening remarks and an overview of the sector.
Okay, first of all, thank you all very much. And thanks, Jay, for the kind introduction. What I wanted to do is, I was told that to spend maybe 20-30 minutes giving you my worldview of what I think is happening and what COVID means for all of us, right? So to start with, I think, and I'm possibly, we are now 2 months firmly into this whole COVID crisis. And I'm sure a lot of you have read and, digested a lot of information from various types of, journals, etc. I'll try and give you my summary of what I think COVID means. First and foremost, I think, like someone mentioned earlier, in the last 100 years, we haven't seen anything like this. And therefore, the closest experience to what we are going through right now is what people equate to the Spanish flu experience, which happened in just after the First World War, around 1918. So it's actually just over 100 years that we're seeing something like this, where today COVID is across 185 countries which have been affected and pretty much touching every part of this globe. So it is a medical crisis. This is a medical crisis which has clearly, from Jan 12th, when WHO called it a pandemic, has spread extremely quickly. And I think pretty much by most experts, they say this is a highly contagious. In fact, the concern has only increased as people have started to see the effect of this, of the way the virus is spreading. And over the last 2 months, actually, I would say all kinds of warnings have actually only increased in terms of how the virus is spreading. Unfortunately, that is real. And because we are seeing now pretty much not just I would say travel-based transmission, but also community-based transmission firmly taking its grip in most economies. I think the one article which, if I would ask you all to read, and maybe there are 3 articles actually by the same person, is by a gentleman called Thomas Puyo. I think it's Pueyo, Thomas. He's written in a journal called The Medium. Okay, screen has frozen. Guys, can you hear me? Hello?
Yes, sir, we can hear you.
Oh, okay. Because Ajay's screen froze, I was not sure whether the transmission was yet continuing. So I was talking about this article by Thomas Puyo in a journal called The Medium. I think if you Google it, you'll find it's possibly one of the most Googled articles today. And I think what he has prescribed as possible measures to contain and control this outbreak is pretty much now what most countries are following. And India is pretty much following to the T. He talks about something called suppression versus mitigation. And the suppression theory is really all about flattening the curve. And you heard about that phrase a lot. And unfortunately, the way this virus is spreading, my view is that this flattening of the curve is only delaying the inevitable, which is that eventually a large part of the world will get infected with this virus. And the estimates are anywhere from 60 to 80% of the population. But most of it seems, will come out of it relatively unscathed, and maybe only 10% might really get affected and may require some sort of treatment, maybe hospitalization. And you will see potentially at the end of the day, somewhere between 0.3 to 0.5% fatality around that. In fact, the New York Times today itself came out with an interesting assessment of the number of the mortality rate, which has been happening over the last few years for all these countries, and the mortality rate this year post the COVID outbreak, and the number of COVID-related deaths. So I'm, again, not trying to cause too much I would say doom and gloom type of a year, but I think what is very clear is that this is a seriously huge medical, which is turning into a humanitarian crisis for all of us. And I think therefore what is happening as a collateral damage is the economic crisis because of the actions being taken by the government to essentially try and control, and governments across the world. So there is, as a result of it, there are 2 simultaneous shocks that we are seeing in the economy. One is what I call the exogenous demand shock, and parallel to that is the exogenous supply shock. And both of these are taking place simultaneously. When you lock down the economy, when you stop goods and people from moving, you're essentially shutting off the tap of what makes the economy work. And this is being done essentially because of the way the virus is spreading, and there not being any cure for it. The cure, even though I read yesterday about Oxford University coming out with some sort of a thing, in my view, and again, based on historical evidence, the cure takes anywhere from 12 to 18 months to actually get discovered, become commercially available, and then really for people to use it to make themselves immune against these kind of viruses. And therefore, this flattening the curve issue, which is basically suppressing the virus, and the combination that you're not going to have a cure for the next 12 months, means that we are in for a period where we'll keep seeing rebounds and spikes in the virus infecting the population, and government continuing to use all kinds of measures to suppress it. And therefore, this lockdown, opening, partial lockdown restrictions, in my view, will continue for the next 6 to 12 months. So any early hopes that people had, especially after looking at the China model, that within 60 days, China opened up Wuhan, is not really, I think, going to bear itself out for the rest of the world. India being in a very similar situation, I think India does not have the healthcare infrastructure nor the kind of discipline and regimen required to control the various, I would say, spread of the virus. And therefore, we have to be, at least my base case now, our earlier base case for our business, we would think that it's a 3-month issue. And after that, things should start coming to normal. Now, it very clearly looks like at least September, by which time then we hope things will start slowly coming back to a normal situation. And then maybe from December, March onwards, we shall start seeing more normalcy return. So we are already, I would say, preparing for, instead of a 12-month period, 18-month period for things to become, I would say, business as usual. What does all this mean from a global economic perspective? And I think it's important, again, because even though we are, as an economy, largely driven by domestic consumption and domestic demand, a lot of that we do, especially on a balance sheet side, the fiscal side, is dependent on what happens around the world. So you all will recollect the global financial crisis, and I think the reason we were able to bounce out of the GFC, which happened in 2008, was one, because India was relatively, as compared to other global economies, relatively underleveraged. Two, because of the high leverage that most economies have, and the global financial crisis really being a leverage and a financial problem, Western economies came back very quickly, pumping in a lot of capital, which is broadly called quantitative easing. And which is what, again, if you see, they're doing exactly the same thing. India does not have that ability to do that, nor did India have the ability to do the same thing even in the global financial crisis. But the difference between that and this is that that crisis essentially was a monetary problem and a fiscal problem, not a medical and a humanitarian problem. And therefore, by putting in a lot of money to work, the economies could stabilize themselves and come out of it relatively quickly. What that also meant is that because of that shock, the global markets went into, most assets got devalued, including commodities. And commodities, typically when growth slows around the world, commodities start coming down. And those are actually good things for India, right? But before, again, coming to India, I think what's going to happen globally, and especially the Western markets, you're already seeing that the first, I would say, reactions have been basically people want to do more things at home or near to home. Two, people want to do more things or less to do with China and more to do with, businesses and things away from China. So you're going to see a retooling of global supply chains. 3 years, I think you're going to continue to see economies print a lot of money. So all the Western economies who have the ability to print money will continue to print money, which means interest rates around the world will remain low. And therefore, the world will start looking at ways and means to improve returns, and they will find ways to go into markets and assets where there are better returns. And finally, there's going to be a slower, GDP this year is going to go into recession globally. I think even in India, there's likely to be, even though the rate of growth estimates are 1.5% to 2% for FY21. In reality, I think it's going to be 0 or negative. Pretty much most other economies have already declared that they will be in a recessionary environment. So the West clearly is going to be in recession. The West will continue to print a lot of more money. I think the West will look at ways and means to diversify away from China in terms of their supply chain, and possibly even move a lot of things onshore, right, into their home markets to try and produce and deal with from a local perspective. For Asia, I think, unlike the West, I think there are a lot of medical reasons people give, and since I'm not a medical expert, I don't want to talk about it. But economically, I think India and China will continue to lead the growth, because a recessionary environment around the world means, and in fact, this is evidence over the last 4 recessions the US went through, India actually grew much better out of those recessions than in normal times. So there is hope, because we will see low commodity prices, oil being extremely low, and that's an actually very good thing for an oil-dependent economy like India. 2, if there is a move away from China, I think India has the opportunity to take advantage of that. The question is how much government and entrepreneurs in India do to actually make that happen. The third is, I think that India's, like I said, domestic economy, which is a larger part of the overall economy, once things do stabilize, whether it's 12 months or 18 months, there is a young, very, I would say, aspirational and energetic workforce and entrepreneurial energy, which should help this country come back more than any government grants or government, I would say, plans or incentives to kickstart the economy. In fact, I'm a lot more hopeful on the entrepreneurial energy rather than actually government doing anything for the economy to come back. Finally, I think the most important thing, as I look at it from an investor's perspective, is global capital flows. I think like most shocks, and this is again another economic shock, the first reaction for most investors is to basically move into a comfortable asset class of their choice. And the two asset classes today, which are outperforming every other asset class, is the US Treasuries, which is basically buying US dollars, and gold. And this is a short-term reaction, which in any kind of a, what you call crisis, there is what is called a fight or flight. This is the fear psychosis of any investor. So the first attempt or the first sign of a problem, people are basically flying, which is getting out. And that's why you're seeing very sharp correction in valuations, the equity markets. Real estate clearly has corrected and will continue to correct more. Commodities have gone soft. Every other type of asset class is essentially devalued, other than for gold and for US Treasury bills, which is basically the US dollar. Because these are the only two reserves which the world believes, and obviously cash, right? Today, the world is flush with cash. If you look at it, banks are essentially providing negative interest rates on deposits within their systems. And this will continue at least for the next 3 to 6 months until there is more clarity on what the outcome of this crisis will be and what will it look like as we get out of this crisis. Having said that, I think once and when we do, and I'm pretty sure we will get out of this crisis, we will then start looking at really rebuilding of various economies and including rebuilding of India. I think in that rebuilding phase, there are three things clearly going to happen. One, you will see a lot of existing players struggle to survive. And in fact, a lot of people, in my view, will also die. Two, you will see industries getting affected extremely differently. That's largely because behaviors will change. Whether it's you as a consumer, you as a person, you as, you know, and we are seeing lives change all around us. And those behavioral changes will drive demand for certain industries and will drive away demand for many other industries. So I would say that will be the second trend. And the third trend is that you will see certain companies who have taken the steps today to secure themselves, bolster themselves, come out of it, really becoming the winners. And you will see massive unfair advantage those companies will have as the markets, industries, and businesses realign themselves in the new normal. So, and in fact, I think, as we all know, right, adversity is the best time to build businesses. In fact, many a times I think that even as investors, when we look back, right, most of the best vintages, and vintages are typically the years in which, you know, investors look at their investment portfolios from a year of investment. So if I've invested in 2010, how did my 2010 portfolio did in 2015 or 2020? Same way, if I've invested in 2020 in a post-COVID environment, I'm pretty sure that the likelihood of this vintage post-COVID is likely to be an extremely good vintage for investors as they look to put new money to work. And I would say, as you know, Charlie Munger in his famous article just last week, as he wrote, when the chips have all fallen and we all know exactly what we need to be doing. So, so long story short, I would say that this is a time to do three things. If you have already existing businesses or companies in which you've invested it, make sure these companies survive, because the survival period, in my view, is anywhere from 12 to 18 months. What does it mean for that? Make sure you've got cash. Make sure you've essentially liquidate it as much as you've got in terms of receivables, in terms of extending your payables, not having too much debt, or if you have debt, at least make sure that your debt can sustain itself through the cash flows, or the cash that you have on hand, because demand has gone out of the window, supply shocks are there, and I think supply shocks will take time to come back as businesses and industries, everything is closed, and therefore first thing is survival. Second, look at, besides the cash and all balance sheet issues, look at all the costs that you have in your business today. What is only absolutely essential, keep it. And the third thing, as you've cut your costs and managed the cash flow, is really start looking at, scenario planning. And this is the time to do a lot of out-the-box thinking. How is your industry going to look? What's your market going to look like for the industry? Is it going to be a much smaller market? Is the market going to grow because of digital transformation? Because that's one of the key drivers. For example, healthcare is going to become an extremely big focus area. And I know today, a lot of people who didn't take healthcare insurance or did not take life insurance or did not take other kinds of insurance, all thinking about taking insurance products, right? So spending patterns will change. And so your business, you have to look at it as what's going to happen, right? If you're running a restaurant business, you're pretty much having to completely retool yourself, right? From a situation where you could pack in a 100-seater restaurant, you could always find 5 or 10 more seats to fill people in on weekends to try and increase your throughput. Today, you will have to be per se be running restaurants with maybe where 100 seats are there, you'll have to only fill 30 seats to maintain social distancing, even after the lockdown and restrictions are removed. So cinema halls, I don't think cinema halls will be open. They'll be the last, I would say, type of places to be open, right? Because the government doesn't lose anything in keeping cinemas shut, but it loses a lot if people go to the movies and essentially continue to infect each other through this virus. So the heat map of affected industries is going to be so different. And therefore, the first and foremost you would say, boss, how do I ensure that I protect what I have here? The second is, I would clearly say is that as you're looking at it, there are, based on what the new normal is going to look like, lots of new areas and lots of existing areas which are going to become a lot more interesting for investing and putting money to work in, right? I think, like someone sent me an interesting WhatsApp message here. Who drove the digital transformation of the company? Was it the CEO? Was it the CTO? Or was it COVID-19? And the answer obviously is COVID-19, right? That even companies who were reluctant to spend on technology and digitizing their businesses today will perforce be required to do that, because suddenly from your 2-year-olds to 88-year-olds, everyone is becoming digitally, I wouldn't say savvy, but at least digitally literate, right? I have senior citizens in my family, and I know they didn't know how to use Zoom or WhatsApp or any of these digital tools. Today, they're all very, very proficient at doing that. They're reading news on their iPads, etc. People are ordering things which they're learning how to do things they never could before. So what happened with the demonetization in 2016, I think the COVID is only going to accelerate the going online or digitization of businesses. So how is that going to affect your ability to acquire customers, your ability to, reduce the costs of operating your business? One of the other things we just noticed, right, literally, is that how seamlessly all our businesses, we were able to move online. And then we start questioning, do we really need so many people? What is our productivity working from home? Do I need that much office space? Can I actually work with half the office space? Or if I was looking to expand and double my office space, do I need to really do that today? So lots of these fundamental, I would say, working habits, way of life, living, etc., is all going to change. What does it mean for businesses? And this is the right time to do that. I don't think it's the right time to necessarily act, but if you start putting in these plans, start building these scenarios, you will be a lot quicker off the blocks as the business starts normalizing to basically take those decisions and start acting on those decisions. The third thing clearly is that I don't think the business of putting money to work is actually going to slow down. There is a lot of money already there. And in fact, like I said, in any downturn, investors are the first to go out there and start looking for opportunities. So if you do have businesses and you are looking to essentially either you're behaving like an entrepreneur who's looking to raise capital or you're an investor who's looking to deploy capital, I don't think you should stop doing that at all. In fact, if anything, this is the right time to double your efforts to actually look for those opportunities, both to raise capital in terms of preparing yourself to do that. Because when we get out of this, we'll get out of this in a manner where there'll be a lot of money, in my view, which will come into markets like India to deploy and to basically, hopefully, bet on the next 5 years in a post-COVID environment. So I'll just conclude by saying, look, it's something that none of us, I especially, have never experienced something like this in my life. So I don't have a playbook. I don't have a rule in saying that you must do this and therefore I only can say that in the best of times, it's very difficult to predict the future. In a time like this, stop predicting the future. Just look at market signals and just take it literally, I would say, week by week, month by month, and be extremely agile, extremely nimble, at the same time, preserve and protect what you have. And then be ready to get out of the gates once you have a good sense, of what the future will start looking like. Thank you.
Thank you, Dhanpalji. Now, between Rajatji and I, we will, with your permission, Dhanpalji, will take some questions. These are based on the questions which have been submitted to us during the registration process, and we'll keep taking some other questions also as they come in. Dhanpalji, you have talked about the paradigm shift in the behavioral patterns of the consumers during at least the phase while the COVID is on. That on the other hand, you have also said that because a lot of economies are printing money and they would be chasing for the returns, there would be a lot of cash flows coming in, or the capital flow would come in. Given this scenario, based on the changes in the behavioral patterns, you have mentioned a few industries, but by and large, which are the 3-5 industries that you see doing well in the post-COVID scenario?
So, look, first and foremost, we are yet, in my view, in the fear phase. So don't expect that this money is going to come gushing in the short term. This is in my view, a 12 to 18 month period by the time you start seeing capital flow back. Unlike, what we've seen in the global financial crisis, which was more, as economists define, as a V-shaped recovery, because this virus is going to keep hitting us in waves. Therefore, the shocks and aftershocks of this virus will continue for some time before we really start seeing normalization happen. And therefore, it's extremely premature to start saying who are the winners today and saying, look, these are the winners you got to bet. And therefore, these are the 3 or 5 industries that you have to basically bet. But so having qualified that, I think you have to start looking at what are the signals. And the signals start from basically how we are seeing behavioral changes driving demand changes, right? Now, the most, why did I talk about life insurance and health insurance? Both of these are sectors which are highly underpenetrated in India, like many other sectors. And the need to spend on insurance was something that most people believed was not a tangible benefit that they saw in the short term, right? Because we are a young population and we really don't, believe that if we have to basically spend on health, that we need to be buying insurance for ourselves, because we believe that we'll be able to deal with sickness and get out of it, right? And why am I'm young, I'm tough, I'm healthy, why should I even want that? So that I'm saying those are the changes, right? Now that will be now because you've got a situation but no one's been able to control, and you've lived through that, and you've seen your near and dear ones get affected. So therefore, parental insurance for people who do have preconditions or pre-existing situations is just one thing that I see. There's likely to be a spike. The second area is basically what I talk about, the whole online to offline opportunity, right? A lot of businesses continue to actually just do business in an offline format. Now, if you look at what Facebook and Jio is doing, and one of the big bets that they're making is essentially on the whole e-mart business that they're building out, where they're saying that we want to digitize, I don't know, the 75 million small shops, kiranewalas, retailers, etc. in this country, right? And we want to be able to make sure that that kiranawala can be as connected on social commerce and e-commerce, rather than just basically being in that shop and selling whatever they're doing through that particular small shop that they have. Now, to what extent it gets realized, and therefore what are the various business models that come out of that? Is it just a one winner take all situation, or are we seeing thousands of business opportunities over here in the local, regional, state, national footprint? It's all kind of what remains to be seen, right? So what I'm saying is that there is a massive adaptation that will happen, and you've got to see whether that adaptation is going to result in the business that you are wanting to put money to work. Is it going to affect it adversely, or is it going to affect it positively? And that's what I meant by start looking for those signals now, but I yet think it's too early to start taking bets saying, "Nahin, ye to definitely mar gaya, or ye to definitely winner hai." That's all I'm saying.
Sure. Thank you. Rajat, over to you.
I think Dhanpal ji is very, nicely covered most aspects of, business going forward. But I'll try and collate 2-3 questions. This is in perspective to startups. A lot of investors and a lot of startup founders are asking, going forward, should we, if we had fundraising plans, should we take them up immediately, or wait because we may not get valued right at the right price, and or we can get rejected at the moment because the sentiments are bad. So then, sometimes rejection becomes a problem, because then even if you go in later, you can face difficulties. And 3, in industries like in startup industries like travel tech and food tech, there is a lot of disruption that's happened in this period. Of course, it's not going to be permanent, but going forward, how should they operate, or what should their modus operandi be?
So look, I think it's very important to distill the macro and then start thinking about what is the impact for your business, right? And any crisis is the best time to really, and I think, take a very hard look at what is the problem you're trying to solve as a startup. And what was your conceived or perceived problem in an environment which was very benign? Is that problem yet a massive problem in a problem where we are today in a crisis? And are you yet believing that even in a crisis or a recessionary situation, which is what we are faced with, that you continue to have a reason to exist in the marketplace and offer that product or service in the marketplace going forward? And the reason why I said have a very hard look is because, frankly speaking, a lot of startups got created in environments which were extremely benign, and where people as consumers of that product or service were relatively relaxed about whether or not they spent on something. Okay, so let me give you, you talked about travel, right? Travel for us was almost like, especially most middle class people had got used to the fact that they wanted to travel once or twice a year on a holiday. Now today, when jobs are in a question mark, increments, all of those things are in a question mark, it's no longer a foreign travel that will take place. And so if you were a travel business essentially helping people decide, curating packages to do foreign travel, you got to think very hard, is this business going to come back at all or not, and what form will it come back, and will someone even pay for it? Or it's going to be a completely different kind of a business model, and therefore I need to be thinking about whether I need to exist also or not. And I can go on and on and on in each industry. And I think it's very difficult to kind of make a generic view, but I think first and foremost, you got to do that. Take a hard look at yourself and say, is there a reason for me to exist? Is there a problem I'm really solving? And if I'm really solving that problem in this environment, and there is a value proposition for the person who's buying this product or service, there is no reason in my mind to actually shy away from the fundraising aspect of it. But put yourself in the investor's shoes and ask those hard questions, that what the investor was willing to fund, which was an idea which may never have been profitable for maybe 3 to 5 years, or let me put it in the 3rd or 5th round also of its financing, but we were willing to go with a theme. Today, those questions are going to be a lot harder, and the investors are going to ask for paths to profitability, unit economics, in a manner where you will be queried, quizzed from 20 different directions. And if you don't have the ability to withstand and question and come out thinking that you've answered and thought through all of the issues, because either you don't know what's happening in the marketplace, or 2, you really don't have the answers, you're not going to raise capital. But I don't think that you should defer a plan purely because investors are not there. You should defer a plan only if you believe you don't really have answers to what you think need to be there for your business to survive. But if you do believe you have the answers, you should be out there pounding the pavement, because I don't think this is a time to ask about valuations. This is a time about basically getting cash, because you can always generate value for yourself and your other shareholders if you are there to survive this crisis. But if you're not there and not able to survive this crisis, because you don't know how long this crisis will last. And like I said, it could come back in 6 months, it may take 18 months. None of us ever. We are only looking at and reacting to what the market is doing today. And if you think you need cash to last beyond the 12 or 18 months, I would sincerely think you've got to start retooling yourself and thinking very seriously about how you raise the cash to survive. Either by doing everything you can, which is in your control today, cutting costs and conserving liquidity, or even just going out to your existing shareholders and saying, look, can we get confidence capital coming in now to allow us to survive? And then can we, then look at raising more capital as our business model is more defined.
Thank you, Dhanpalji. There is, since there are a lot of investors on the session today, some of them have asked 2 questions actually, which are related. So we'll take them together. They want to know what's your investment philosophy in terms of what do you look for before investing in a company, and more granular details on what do you look for in the promoters or the management team.
So our business model is slightly different. Obviously, we do have different businesses. We have infrastructure, real estate, private equity, and venture businesses. I won't talk as much about the venture. Let me say, the venture business, the way we look at it is clearly because there's no business plan. We are doing Series A financing. We are actually betting on the team, which is the founding team, and we are betting on their ability of having taken a product to market and proving the initial commercialization or the commercial success of that product. And we've been very focused on consumer, and that's where really we've been focused as an investor. So these are 2 critical things. Is this a niche product serving a niche need? And have the founding team actually been able to commercialize it and prove unit economics at the price points at which they have basically commercialized these products? From a private equity and an infrastructure investing perspective, we actually do more buyouts and platforms. So what we do is essentially buy businesses, take 51 to 100% control of businesses, in which we sometimes inherit. So the founding team or the management teams come along with it. We may keep them if we believe that they're the right team to back and to continue to build, or we may even bring in high quality professionals to run these businesses. So that's a model in which we almost become the promoters of these businesses. We are the promoters, and as owners and operators of these businesses, along with the management teams, we actually run these businesses. And we do it in 2 ways: we buy and we build. So we've built, businesses from scratch, literally put in capital, set up the company, hired the founding team, and then really, but the 3 things we look at over there is a market which is wide open. So a lot of the unorganized sector businesses which are becoming formalized or organized, we like those types of sectors. Climate, for example, is a big area for us. We are investing in renewable energy, in electric mobility, in energy services, efficiency, all those kind of things, which are all, if you look at it from a global as well as an India perspective, are businesses of the future. So if we can build highly scalable businesses over there, we are very, very keen to invest in those markets. We obviously, what we don't like is businesses where there's too much technology risk, where you're backing a new technology and you don't know whether the technology is going to work or not. We don't like commodity businesses, so like steel, cement, sugar, paper, those kind of things. It's not something that we like and we like to do. We don't like, typical manufacturing type companies which have a limitation, because the limitation for manufacturing companies is that they can only produce that much, and there is only that much value add they can do to that production. And therefore, unless you keep putting in more capital, it's very difficult to basically. So this is private equity. In infrastructure, we would clearly do, I would say, building assets, which is asset intensive businesses, but with converting a project into a very predictable annuity cash flow stream business. So quite different. So different strategies for different. So it's not the same for each.
Yeah, thank you. Rajaji?
So I think there are a lot of questions. I mean, every alternate or third question is on real estate. Just very quickly, if you can just say going forward, residential real estate, commercial real estate, affordable housing, one as a business, two as an investment. If you can share some views that you may have on that.
So one, I'm not an expert in real estate. We do have a business, but that's run by one of my partners. We've done a lot of lending to the real estate industry, so I can give you a little bit perspective from that angle. I think the fundamental issue, which today, let's first take it from a business perspective and then from an investment perspective, is that from a business perspective, real estate has no longer become is no longer a land arbitrage business. Land and regulatory arbitrage was the biggest value driver for real estate as a business, where you went in, you had the opportunity to either clear a title, clean it up, or to aggregate land, or to essentially convert the use of the land from one type to another type. And so there was a lot of arbitrage which was taking place on the interpretation of the rules, your ability to manage the system, and essentially bring in risk capital. Very little of the developer's own capital went into the business earlier. A lot of the risk capital came in from informal sources of finance. And you did all of these changes, and therefore 80% of the returns in that business really came through activities or initiatives the developer did even before he started construction. And the construction part of it was only a 20% of the value driver. And I think that entire equation now is reversed. It's inverted actually, where today, because of regulatory reform, because of transparency, because of a lot more, I would say, competition in the sector, all of those market asymmetries have by and large gone away. And therefore, really now, 80% of the value now is in terms of the whole starting construction to completion phase, where you need cheaper cost of capital, you need very strong financing and construction capabilities. Marketing and sales plays an extremely important role in terms of getting premium for your asset as compared to another developer. So a lot of those things go in. Therefore, I think 90% of the industry will, in my view, die or just disappear, right? So from a business perspective, I have a very, very bearish view. From an investor perspective, again, I'm looking at it differently. I think real estate has already been on a bear phase for a fairly long period of time, and it will continue to be, I think, for at least the foreseeable next 2-3 years. There is a point at which today the cost of delivering new real estate has come pretty much in many markets to parity, wherein essentially if you buy the land, construct, and deliver, that's where you basically are seeing selling prices, and maybe even lower, right? But there is yet a lot of inventory which is continuing to be there in these unfinished inventory, which will have to play itself out before you start seeing any kind of improvement in prices. So I think it's a time to play real estate through credit, through distress, rather than really playing it through a normal investor opportunity.
Thank you. The next question is, there are 3 questions which are related, and they have been asked from the current investors who say that their ticket sizes are small, like the venture capitalists. So they want to know what is your advice or the guidelines you would have for them going forward during these difficult times. The corollary to that also is that how should they monitor their investee companies during this difficult phase? And the third corollary to that is that if they want to be the venture partner in the tier 2 cities and some opportunities related to that based on the behavioral disruptions which are happening or the changes, if they see some opportunities in the emerging sectors due to this change, how should they go about doing that?
So I think on the first decision on investment strategy, I think what we've seen successful investors do is that they don't stray away from what they really understand. So if you've been an investor in consumer, if you've been an investor in tech, or you've been an investor in even, business services or whatever it is, you would already have a view of what you're comfortable with and what you know and what you don't know. So this is not the time necessarily to start doing things you don't know or what you're not comfortable with. So in fact, if anything, I would say you should be doubling down on your efforts to focus on investments in areas where you're already comfortable and you feel you have a good understanding of assessing those types of opportunities. Because like I said, valuations have corrected across all asset classes. And therefore, right now will be the right time over the next 6 to 12 months that you will find very interesting opportunities at valuations which you will be much more comfortable with, and maybe less competition for those opportunities than what you would have seen 12 months ago. So that's my first from an investing perspective. Second is from, what was your second part to the question?
Was if there are like small ticket investors and the tier 2 cities, if they see some opportunities in those areas, like not the high ticket investors, but small ticket investors, should they go about making those investment decisions now during this phase of uncertainty?
Sorry, I think there was a second part to that question, which is more how do they deal with the portfolio and how should they monitor that?
Yes.
So I would think that's right. So that's where really, I think if you ask me, this is the time to look at your portfolio very hard and see whether they need money. And I don't know because each investor has a different relationship with their portfolio companies. Sometimes the portfolio companies are too busy to even respond in these times, right? Because they're going through the crisis themselves. There's a lot of anxiety. Mental health, in my view, is a massive issue. Motivation is a massive issue. Entrepreneurs and promoters feel completely alienated. They feel completely lost. And I think this is the time where you have to go and support them and literally like putting an arm around them and saying, look, what can I do to help you? Right? It's an extremely important, just to give comfort is extremely important these times, because these are very, very tough times most companies will go through. And taking those decisions, right? If you have to let go people, if you have to cut someone's salary, or you have to basically, tell a supplier, sorry, I can't pay you. These are very challenging, interactions to be done, right? So how can you support them in this next 1-2 months as they have to live this in a very difficult environment? The second is helping them plan that, right? Okay, coming out of this, what's going to work, what's not going to work for us? And how much is the capital that you need? And is it something that, it could be a down round, for example, right? People may have gone in at a certain valuation and the company needs money. And you say, look, I know it's going to be difficult because you may have raised XYZ at X valuation last year. And today, this market is very different. But if you do read the capital, I yet believe in you. I believe in the business and I yet may want to put in the capital, provided 1, 2, 3 things are there, right? So that's a straight opportunity. I look at it in an adverse situation for you to look at. Obviously, there may be a strong view. You take that look. I think I made the mistake. I put the money. I made a mistake. I don't think this business is going to survive. Don't double down. You don't have to double down. You can just decide that. Let's see what happens, and maybe someone else comes in and puts in the capital to, help the business tide over this crisis or help it take advantage of this opportunity. So in some ways, I've answered your third question also through that.
Sure, yes. Yeah, thank you. Thanks. Rajatji?
So I think, Dhanpalji, would you like to take some more questions? Or I think we've covered most of the questions and, of course, mostly which are sector agnostic. We've covered investors, we've covered businesses, we've covered startups. Manojji, Dhanpalji, Ajayji, what do you think we should take?
Yeah, there is one question actually which has come in, if it's okay, Rajatji.
Sure, absolutely.
Yeah, Dhanpalji, there are 2 or 3 questions revolving around the same theme that I think you have briefly referred to, which is, people are now wary about dealing with China, or at least they need diversification of their supply chain. So from that standpoint, which emerging opportunities do you see as the investors and also again as the entrepreneur, for the entrepreneurs also, like when this phase starts or when this transition starts, India can play the role in the global supply chain. So which sectors do you see benefiting from that paradigm?
So I think, China was already seeing, because of the trade wars between the US and China was already seeing a significant, I would say, pressure and there was a fair amount of manufacturing which was moving away into Southeast Asia, right? India could not take advantage, partly because everyone keeps complaining and blaming the government, but partly also that Indians, I think the ones who we generally have a cultural issue in terms of promising too much and not delivering enough. And I think global investors have a very, very, I would say, thin line of patience for companies who basically promise something and deliver something else. So I do believe that our strengths are in obviously a lot of engineering related exports, whether it be auto related, a lot of textile related exports, lots of other consumer products. Tech, I think tech manufacturing will become increasingly, because India is also becoming a large tech consumer, right, of tech products here. So the logic of both setting up local businesses or businesses of manufacturing capacities to supply local businesses and global markets, I think is becoming that much more interesting. The the rupee depreciation. So we have depreciated against the Chinese currency, and to that effect, obviously against the US dollar. So that also should, I think, add to, I would say, short-term opportunities. But in my view, the currency only kind of is useful for existing exporters. One should not look at that as a long-term kind of sustainable view, but we should kind of, I would say, all the other things I talked about, right? But I yet believe in India, it's generally quite difficult there because there are lots of other issues around supply chain, ports, logistics, all of those things which continue to be a little bit of a challenge.
Sure.
So don't expect too much to come, but if you already have good businesses which are doing that, I think it's a great and an opportunistic time to try and talk to customers to see if they're willing to give you the long-term contracts, which today no one will be willing to do so. But I would again say that just watch these signals very closely and be ready.
Thanks, Dhanpalji. Two questions related to the education sector. They want to know your views on education sector, and some are saying EdTech, education technology related startups. Your views on that?
I think that's one area I see a significant positive move coming out of this crisis. In fact, the brick and mortar model of universities will start getting questioned because everyone is now doing Zoom classes, everyone is teaching remotely, students are getting adjusted and getting used to it. Parents are loving it because the kids are right next to them when the classroom learning is happening, and they're able to see a lot more what's happening with the kids. They're able to focus and they're able to actually participate in that whole experiential journey. So I'll be, and I think government regulations always follow. So I wouldn't be surprised that you will see K-12, secondary, junior college, university level education, a big chunk of it moving online, and maybe just weekend classes happening in person, and during the week people basically just learning online, right? So I think education will see far moving changes in behavior if one were to kind of look at a sector.
Sure. Thank you.
So yes, it's a good opportunity.
Sure.
So last question, Dhanpalji. Our topic said future of long-term investments in India as a private equity destination. Maybe you could just sum it up by covering the future of long-term investments in India and in general, and India as a private equity destination.
I think India long-term is, I keep telling everyone, I'm long-term bullish and short-term bearish. So I'm very critical of what's happening now, but I'm always bullish on, the future for this country here. So it's the same like talking macro and talking micro. In the micro, you have to be extremely critical of your businesses, your investments, the way you evaluate it, the way you essentially, because that helps you hopefully take the right decisions in a market, and a business will always be very volatile. And unfortunately, what's happened is that the volatility, especially because of natural causes, has only increased. Earlier, volatility used to happen because of, policy action, government action, all of those things. But now volatility because of market, natural disasters, right? Floods, famines, these kind of viruses, what's happening, like, the fire burning in California or Australia. These are, every year it's increasing and increasing and increasing. And it's some way Mother Nature telling us, right, that we are screwing up the earth. and we have to slow down. And maybe this is their way of telling us, guys, you need to slow down and not pollute so much, and not cause so much damage to the earth. So yes,
Manoj?
that's my view.
Sure. Thank you, Manoj.
Dhanpal, I have a last question just to understand. You've been active in certain sector. So are you still post-COVID India policy and the worldwide policy still going to be focused on those sectors, or are you going to have some change in your policies in terms of your investments?
So our sectors we've chosen are from two angles. One is what will drive domestic consumption, and two, what will drive dollar revenues. Because our investors are global investors, mainly dollar denominated. And one of the biggest drags on our returns, that even though we may have generated very good returns in dollar terms because of the depreciation of the currency, so we kind of financial services, the wider healthcare, life sciences, consumer and tech services are the four areas where we look at it and which we'll continue to put money to work. The new area for us is climate. We think India will actually accelerate its investment in climate related or climate change related investments. So electric mobility, I think, is a theme for this next 10 years, this decade of 2020s. And we're going to be investing heavily in that. Water is the second theme we'll investing in. Waste is the third theme, as urban economies increase and waste increases across all parts of our economy. And energy, which is renewable in nature, is the fourth theme. So our climate change theme will cover these four areas.
Sure. Thank you.
Thank you so much. And we, as a JITO, we have already invested in a couple of companies in mobility and also in the electrical vehicle mobility. Thank you so much, Dhanpal. Any other question, Ajay and Rajat?
No, just I'm tempted to ask one more with your permission, Manoj.
Of course, yeah, of course.
No, since Dhanpal, since you already have a separate fund created for green energy, in the interest of the startups and the entrepreneurs here, would you want to throw some light on like what the typical ticket size or what kind of ventures do you look at investing?
Yeah, so we use a very similar to our private equity strategy, which is a build out or a buyout strategy. So we've now invested in 3 companies, 2 of which we actually set up ourselves. Those 2, one of them focuses on essentially renewable energy to customers. So over there, it's a company called Radiance Renewables, which does everything from based solar to solar solutions behind the meter, renewable energy solutions behind the meter. The second is Green Cell Mobility, which focuses on electric mobility services. So we don't invest in manufacturing over there. We invest in basically providing mobility services to consumers, right? So it's across bus, 3-wheelers, 2-wheelers. We're looking at everything in that space. The third investment is a very large, and each of these investments we have committed around, on an average, I would say between 300 to 700 crores of equity investment in each of these companies. Wow. So our ticket size is fairly large. We look to make reasonably big bets, and then we go in all in. We don't then. We obviously drip feed capital. We'll put in very little money, and we keep building out the business so that generates better returns for us. We don't have to put in all the money on day one. But in a 3 to 5 year business, all of these businesses will be very significant businesses.
So given the mandate of the Mother Nature, as Dhanpalji, as you have said that they have probably evaluated or adjust human being as the culprit and put us at the home arrest, and they have the sentence is yet to come in. But given that backdrop, I think green energy and the sectors that you are betting on would really make you one of the visionaries of India, and that would benefit not only India as a potentially leader into green energy, but it will also create a lot of jobs. So we thank you for that. Over to you, Manoj.
Thank you so much, Dhanpal ji and Ajay and Rajat. Thank you for giving insights, what is going to happen, what things you understand, what we feel. We have also, investors have also asked you on the questions.
Manoj,
Anything
sorry
else,
to
Rajat, you want to close this?
Manoj, sorry to interject, but
Yeah.
I think there are, can I just quickly respond to some of these chat messages which are there in kind of literally in one word and one line, because there are lots of small questions which are there. And I'd find it unfair if these people don't get their responses. So I'm just reading the last few questions and I'm going bottom to up. Okay, so you'll just have to bear with me for that. So yes, Thomas Pio is the name I said. P-U-E-Y-O is correct. It's T-H-O-M-A-S. So please Google him. Fantastic articles. Please read. I would encourage everyone to read that. 92% startups are unfunded. I think it's not 92%, but in my view, you will hear of a lot of startups which don't even basically are able to go and raise capital. And the mortality rates typically are 99% for most businesses, which survive for 10 years plus. Financial services entrepreneurial opportunities, huge, especially in distribution. I think it continues to be, there is a lot of micro opportunities in, on, I would say, the intermediation side. But otherwise, increasingly, financial services is becoming either tech-driven, and that is taking much more time to build. QSR, very difficult funding in this scenario, unless you've got some global brands with very high-quality local teams. In my view, just prepare for a very long winter. It's not going to be easy. Government, I have no expectations with regards to stimulus. Top 10 companies, we've done some phenomenal pharmaceutical deals. We bought a very interesting business. We bought Modern Breads, which was in a category which was very slow growth, but literally in this lockdown, it's been growing 30% and operating at 110%. So, सब लोग घर पे सैंडविच खा रहे हैं यार, तो हमारा outsourcing for finance process, okay, blah blah blah. Marketing, retail lending will eventually come back. Credit is the mainstay of any economy, but I think 90% of NBFCs will collapse. You will see very few NBFCs survive this crisis. Gold. I think lots of stories I'm reading on gold, and it continues to be, at least in the short term, the best asset class. Low oil prices for India is fantastic. I think India, unfortunately, does not have enough storage, but China has been buying. If you look at China, Japan, South Korea, have each 500 million barrels of storage capacity. India only has some 35 or 40 million barrels. So we are really woefully inadequate. And if we had storage capacity, we should have just bought all the oil which there is. Because oil at $20, you saw there was a negative contract in May futures. It's just a phenomenal boon here. We use, I forget the exact number of barrels, but close to about, I think 110 or 120 million, 110 to 120 billion dollars of oil imports every year at average of $60, $65. So the oil going to half, that means you're saving $50, $60 billion of oil. But what India will do is basically they'll just increase the taxes. So आपका oil का दाम कम नहीं होगा, but government को फायदा होगा. और क्या है यहाँ पे?
I think there was one on the Jio and Facebook deal. If you want to throw some light on that.
Boss, two giants. So boss,
this is a repeated
just be sure you don't get crushed in between. That's all. उनके छाए में रहो और कुछ अच्छा business करो उनके साथ. बस.
Dhanpal, a question. Do you think any sector which is going to surprise you, or any sector which is going to be a surprise package post recovery?
Yeah, I think only one thing, boss, Manojji. I've always seen life is never as bad as it looks, and it's never as good as it looks. So इतना हम लोग खराब सब कुछ बोल रहे हैं, वो खराब नहीं है इतना, right? Things will come back. It's like I don't believe that you're going to stop going to the movies 1 year or 2 years down the road. But for the next 2 years, the movie business is dead. Okay, all these Akshay Kumar and all will have to change and basically become Netflix stars, right? Because PVR and Inox will have to basically shutter a lot of their businesses for the next 1 to 2 years, because you and I are not going to go to the movie theater, guaranteed, even if you want to, right? Your wife will stop you, or your daughter will stop you, or someone will stop you saying, boss, why do you need to go? Let's watch it, not Netflix. So, but at the same time, does it mean that it's gone forever? No, I don't think so. It will come back. But, you know, what you have seen is massive value destruction in the meantime. So maybe both don't survive, maybe one survives, you know, market may be smaller. But, you know, I have seen businesses where the industry is shrinking, but players within those industries outperform the markets year on year on year. So you've got also, as an investor, got to think about those opportunities. If the market size totally shrinks, doesn't mean that there is no opportunity to make money. There will be some players who will survive and do phenomenally well because everyone else is dead.
Yeah.
So that is also, I think, consolidation will play a big role over here, and a big theme in my view. So look at all of these kind of, you know, I would say trends and themes playing out.
Thank you.
Thank you, guys.
Thank you so much, Yaar. Yeah.
Rajat?
Should we close this, Rajat?
So I think Dhanpalji has covered everything well beyond our, request. Thank you once again, Dhanpalji. It was an absolute pleasure to have you. JIIF and JPF and JITO are extremely, always excited to have you as an expert advisor. Thank you, Ajayji. Thank you, JPF, Mr. Ravi Jain, Manojji, and everyone else who's joined us today for this session on private equity and India. See you soon.
Thank you. Thank you.
Thank you all. Bye-bye.
Bye. Take care.